Well, hi there. Welcome to the 11th annual How to Read Tax Returns and Close More Loans. It's my belief that once you know where the numbers come from and become proficient in analyzing tax returns for your self-employed borrowers, you'll be able to get more loans approved, period. Another compelling reason to become proficient at understanding cash flow and reading tax returns is that you'll develop a reputation within the CPA and financial advisor communities as being an expert in working with self-employed business owners. Now, there's plenty of courses available on how to read tax returns, and some of them devote an entire day to this subject. I've attended several of these personally and can tell you that they're great, but I wanted to bring you this course from the perspective of a fellow loan officer right there in the trenches with you. I've worked with a lot of self-employed borrowers, I've looked at a lot of tax returns, and I know how to get these loans approved and closed. Now, for a quick word of introduction, my name is David Kuiper, and I'm just starting my 28th year of originating mortgage loans. My practice is based in Holland, Michigan, and I've personally closed over 6,000 loans that total over $1 billion in production over my career. I've had the honor of being ranked among the top loan originators in the country for over half of my career, and I would attribute a great deal of this success to hard work and to being a student of our industry. So congratulations on making the financial investment and the investment of your time in participating in this class. But enough about me, let's get on with it. I'm going to warn you that there will be a lot of slides coming your way and that I'll be going through them quickly, but don't worry. I'll highlight each of the areas on each form that you're going to need to focus on, and then at the end of the presentation we'll be providing copies of the slides and tax forms and notes to recap everything that you're about to learn or refresh your memory, as the case may be. Of course, this is a little more dry than some courses as it's pretty technical in nature, but I'm going to try to have fun with it if that's okay with you. So remember, if you learn just one tip today, you're going to be better off because of it. The underlying principle of this course is that taxable income does not equal cash flow. Today's presentation is designed to be an overview of reading, analyzing, and understanding the tax returns so that you can derive what true cash flow actually looks like for your self-employed borrowers. My goal is to help you think like an underwriter, prepare you to go to the mat with an underwriter, and familiarize you with the common elements that you're going to be seeing time and time again. And understanding the why behind the numbers is what this is all about. So I'm sure you've heard in the past something like, oh, I went stated income last time, or my tax returns didn't look so great last year, or something like that. Well, obviously stated income loans are a thing of the past. Some originators just take these comments at face value and don't even try to work with a self-employed borrower. Or they'll go through time and energy, also called pain and agony, of collecting the tax returns and making copies and then not knowing what to do with them once they've done so. In my experience, you'll typically find more cash flow in a tax return once you learn how to read them than what's being reported as taxable income. That's one of the beautiful things about being self-employed, right? I once had a client who owned multiple businesses, and his tax returns showed taxable income of about $500,000, which is not all bad, right? But after analyzing all of the interrelated businesses, his true cash flow was over $40 million. And I'm pretty sure I can qualify somebody for a loan with that sort of cash flow. So knowing how to accurately calculate cash flow for your self-employed borrowers will help you submit your loans with the correct income calculation the first time so that your underwriter knows that you know what you're doing and isn't tempted to second guess your figures. And once you've got a great relationship with an underwriter who knows you know what you're doing, it'll just make the loan approvals that much simpler and smoother. Let's talk about when do you need to collect a tax return. Well, in today's world, the simple answer is always. You might not want to over-document your files, but I can tell you it's always better to have all of the information that you're going to need up front rather than forgetting or overlooking something and then finding out that you're going to need it later and getting caught and looking silly, or even worse, having a loan blow up because of it. Now, there's 4 times that you absolutely need a copy of a tax return. A borrower is considered self-employed if they own 25% or more of a business. Now, that might come up on a 1003 or in a discussion during a planning session with a client. They'll typically answer yes or no when completing their 1003. And sometimes say something like, I'm a minority owner, or something like that. But the simple cut and dried answer, 25% of ownership or more, is considered self-employed. The second reason that you need to analyze a tax return is if your client receives more than 25% of their income from anything other than their base income. This includes things like bonuses, overtime, commissions, piecework, and that sort of thing. The third reason that you're going to need to have a tax return is if somebody works for a family business. Now, you probably don't ask as a standard question when you're interviewing a borrower, do you work for a family business? But it's fairly common if you see John Smith working at Smith Excavating that might be a family member. And that'll give you a clue if they own the business or might be related to the owners of the business. And we need to document either they do or they don't own all or part of that business. And this is done by taking a look at the tax returns. And the fourth reason that we're going to need to take a look at a tax return is when somebody owns rental property, so that you can determine whether this property is generating a net income or a net loss. In this course, we're going to be taking a look at 4 different types of self-employed borrowers. The sole proprietor, this is the small one-man shop. They're personally liable for the debts of the business, and they're going to be reporting their income on Schedule C in their personal tax return. They'll also be personally responsible for any of the income taxes incurred by this business. There's a couple of different types of business partnerships, general partnerships and limited partnerships, where 2 or more individuals or businesses are involved in a business together. We'll also be taking a look at S corporations. These are similar to partnerships, but the way that the liability is treated differs. Either way, it's 2 or more people participating in a business together, and sometimes partnerships are partners in other partnerships, and that might seem kind of strange or difficult to understand, but once you get a handle on how and when the tax returns interact with each other, you'll be able to follow the money and the cash flow like a pro. Partnerships and S corporations don't pay income taxes. The taxes are going to flow through to the personal tax returns of the partners and will be paid by them personally. And we're going to be looking very closely at how do we track this. And the fourth type of self-employed borrower is going to be the traditional corporation, sometimes called a C corporation. This would be a stockholder-owned entity, and the taxes and liabilities are the responsibility of the corporation.